Welcome and thank you for watching this video on absorption costing. Make sure to stay tuned until the end, and I can assure that you will become a master of absorption costing. There are several reasons why a company may need to calculate the cost of its products. It may want to set prices for its products, make strategic decisions regarding production priorities, determine the value of products held in inventory, and record costs on its income statement for sold products. A company's costs can be divided into two categories: non-production costs and production costs. Non-production costs include the expenses related to selling and distribution, general, administrative, and advertising. It is important to know that non-production costs are period costs and are not covered by absorption costing. On the other hand, we have production costs, where absorption costing focuses. These costs start with direct materials and direct labor, which are the primary costs involved in production. Direct materials refer to the materials used directly in the production process, such as raw materials needed to make the product. Direct labor refers to the wages paid to workers who directly worked on completing the product. All other production costs are known as production overheads. Those include indirect materials, which are consumed during the manufacturing process but are not integrated into the final product. Examples of indirect materials could be cleaning supplies or bulk purchases like paper and office materials. Indirect labor, such as the salary of a secretary or a supervisor, is also considered part of production overhead. Costs like factory and equipment rental, utilities, and depreciation are classified as overhead, while the same costs related to administrative facilities are considered non-production administrative expenses. In absorption costing exercises, there are usually two parts. The first one focuses on prime costs and is the easiest part. The second one deals with overheads, but we will discuss it later. Remember, practice makes perfect. So let's work on our first exercise regarding prime costs. A company makes one product which requires 1 kilo of material A, 2 kilos of material B, and 5 hours of direct labor. Material A costs $20 per kilo, material B costs $10 per kilo, and direct labor costs $5 per hour. We are asked to find the primary cost. As we already know, it is equal to the sum of direct material and direct labor. The direct material cost for material A is $20 because we only need 1 kilo of it. The direct material cost for material B is also $20. Therefore, the total direct material cost is $40 per unit. The direct labor cost is $25 because we multiply $5 per hour by 5 hours. So, the total prime cost is calculated by adding the direct material cost and the direct labor cost. In this case, it amounts to $65 in total, $40 for direct material and $25 for direct labor. Now let's discuss overheads. When estimating production overheads per unit, there are two important factors to consider: budget amounts and budget levels of activity. The idea is simple. The production overheads will be distributed among the units that are produced. The assumption here is that overheads depend on the number of products produced. However, we use budget amounts and budget volume to perform our calculations so that the absorption of overheads can occur throughout the entire year. Companies determine their levels of activity using one of the following three options: units of production, machine hours per unit, and labor hours per unit of production. However, when a company produces multiple units, using units of production as a metric of activity level is not appropriate. If the production process relies heavily on labor, labor hours are used as the activity level. On the other hand, if the production process relies heavily on machines, machines hours are used. To allocate the overheads to the units, an overhead absorption rate is used. This rate represents the ratio of production overheads to levels of activity, and in order to gain a better understanding of this concept, Let's move to the following exercise. So here in our exercise, we have a company that produces two products, product A and product B. We have some cost data about these products like direct material cost, direct labor cost, direct labor hours per unit because production is supposed to be labor intensive, as well as the expected production in units. Here we are also given the expected fixed cost of the company like factory rent, equipment depreciation, marketing expenses, finance cost and utilities. And the first question is to estimate the production overhead per unit. In this case, as we have already discussed, we have to estimate first the overhead absorption rate, that is equal to the expected overheads divided by the expected level of activity. We will start by the expected level of activity that is equal to 30,000 times 1 labor hours for product A plus 25,000 times 2 labor hours for product B, and the sum is equal to 80,000 labor hours for both products. Here are the expected overheads, and their sum is equal to $200,000. However, this is actually a trap because people often confuse the period costs like marketing expenses and finance costs with the cost of product. So in this case, we have to exclude marketing expenses and finance cost and to estimate again the total overheads that are equal to $150,000. And so we can estimate the overhead absorption rate as the ratio of the expected overheads divided by expected level of activity, and this is equal to $1.875 per labor hour. Here is the data of the previous slide again, and the production overhead per unit for product A is $1.875 because it requires only one direct labor hour, whereas the production overhead per unit for product B is equal to $3.75 because it requires 2 direct labor hours per unit. The next question is to estimate the total cost per unit. Now the process is much easier because we have to aggregate the direct material cost, the direct labor cost and the overhead for each product, and the total cost per unit is $27 for product A and $34 for product B. As we discussed before, the overhead absorption rate is a useful tool for calculating the production overheads per unit. However, it can lead to situations where we either absorb too much or too little overhead costs compared to the actual ones. When the absorbed costs exceed the actual costs, it results in overabsorption. In this case, the difference reduces the cost of goods sold and maybe the value of inventory in case of unsold products. Conversely, if the absorbed costs are lower than the actual costs, we have underabsorption. The difference increases the cost of goods sold and maybe the value of unsold products. Thank you very much for joining me and watching this video.